Allan Advisors, creating aha moments, presents Aha Business Podcasts. We provide opportunities to discover information to help you run your business and guide your decision making. The more you know, the better decisions you make. For more information, log on to allanhirschadvisors.com. I'm your host, Allan Hirsch. All right. Welcome to today's podcast. My guest is Mike Brown. He's the CEO and founder of Red Fox Capital and Red Fox Wealth. We're going to be talking about some interesting wealth management issues today. So welcome to the show, Mike.
Thank you, Allan. I appreciate joining the show today.
Well, what motivates you to get up in the morning and go to work?
Well, I tell you, I think, some of the things I think we'll discuss today and how to implement commercial private real estate into individuals' investment portfolios drives me and motivates me to get up, because it's I feel like I'm a lone soldier out there spreading the gospel about these new strategies, and it really it gets me excited.
Okay, so what is the new strategy? How'd you get started in the real estate and wealth management, and what is that strategy?
Well, first of all, I guess it's about 20 years ago. I had a unique opportunity to join a commercial real estate firm, a small firm out in Great Falls, Virginia. That gave me real estate development, investment, construction, consulting, and gave us a really good foundation understanding of the business. And out of that, we were able to develop our own real estate funds and syndications. And in that process, we started to go to wealth managers and looking for more capital, thinking this would be a no-brainer. These guys need to diversify their clients into other alternative assets. And they were receptive until the point of actually introducing us to the clients. And I learned there was a conflict of interest there, because if they introduce us to their clients, they're going to lose their own fees and their assets under management. And I was like, this is not right. We can really diversify and help the clients, and there should be an answer to this. Fast forward, my partner and I have created a wealth management company under the same roof as our real estate investment company. So we're able to break down all the walls of conflict and create diversified, strong allocated investment portfolios and drive not only safety and security, but also returns. And it's been a great experience.
How do you work with these people if they're reluctant to work with you in wealth management?
Well, it's obviously not an exclusive relationship. If someone is with another wealth management company, we can still work with them on the real estate side. We definitely prefer to have the entire picture, and obviously, give our clients first pick of any new investments releases. But it's an open book. Anybody that wants to work with us on the real estate side is more than welcome. But like I said, we prefer to give somebody a comprehensive view of their portfolio.
So tell us about your new book, and you devoted 2 years to writing it.
Yeah.
And how does it play into what you're trying to do?
Well, the new book is called The Real Perspective. Hit number one, I think, in 4 categories last week on Amazon. And it really is the story about what we just discussed. I take a long historical perspective of Wall Street, look at the returns of the S&P 500, and then we show some strategies of implementing an allocation of private commercial real estate, and show the bottom line. The numbers prove themselves to be very strong argument to put private commercial real estate in your portfolio.
Are investors overexposed, and how do you go about getting the investors, and what are you looking for, and what are they looking for in order to get good returns?
Sure. Well, I think one of the issues is the traditional investor, here's the song from the Wall Street advisor that you're diversified. We have you in a solid diversified portfolio, whether that be ETFs, mutual funds, or whatever it may be. But what the real fact of the matter is, they're diversified only on Wall Street. And we think that can actually hurt you especially in today's world. We see the roller coaster ride of Wall Street. So what we try to communicate with our people is to take a look at their entire financial plan, and we create 3 buckets. So we try to see your exposure in Wall Street products, your exposure in alternative investments, which would include the real estate. And then our 3rd bucket is cash, fixed income type products that are uncorrelated to the markets. And then see where all that lays out. It depends, obviously, suitability for the individual client, depending on what their retirement goals may be, their age, net worth, and we'll step back and we'll help allocate the bucket to maximize their returns and security.
So how do you go about doing this investment in real estate when most financial advisors don't touch it?
Absolutely. And that's the mission we're trying to go out and sing, because, I went through the Merrill Lynch program, worked at Merrill Lynch, and we were prohibited from talking about commercial real estate to clients. It's a term called selling away. If we offer a product or advise a product outside of the actual captive financial advisory company, it's prohibited. And so we have to, step back and educate I say this too, that the average financial advisor, if you came to me and said, I want to have exposure to real estate, what they're going to say is you should buy a REIT stock, a real estate investment stock. And that's great. That is a commercial real estate holding, but it is completely correlated to the stock market. It's a traded stock. So to me, that doesn't cut the mustard.
So in this COVID environment, what are you doing to protect the real estate investments?
Right. So, we've obviously had to, look at the long-term play here. We've maneuvered into triple net leases, properties like we talked about, the Dollar General stores that are little cash cows. And we put together an entire portfolio of those and are able to give our clients a nice dividend check every quarter. And they are backed by the actual corporation. So the leases are guaranteed. We have a lot of individuals that like multifamily. I don't particularly deal with that directly, but we have other partners that can. And, the big scare back in early March when COVID started was, are people going to stop paying their rent? We watched that closely. And the good thing is we've only seen maybe a 2 to 3% drop right there in the early stage of COVID. So it's been somewhat solid. I think the one asset class that we've never go near any longer is general office. And, even today, we're in the Zoom world, I think the general office space is going to be a tough one.
Yeah, well, I know one law firm in the Baltimore area. It's one of the fastest growing in the region. At least 60% of their attorneys say they're not going to come back to the office.
Right.
They're going to continue to work from home.
Yeah.
New York City has been a ghost town.
Absolutely.
And how many of them are coming back to work in New Manhattan?
Yeah, I think New York City's got a lot of problems besides just the real estate market.
Yes, but they're literally one of the safest now with in dealing with coronavirus, but they're in deep trouble in commercial real estate.
Well, we have a particular friend of ours that is a government contractor in the DC area, and it costs them $500,000 a month just to disinfect the office space because of COVID. So it's cheaper for us to keep everybody home and try to buy out early term leases because in the new world, it just doesn't make economic sense.
So anyway, we'll talk. That's a different story. So we'll work on talking about that. So how do you invest in it, and how does the investor become semi-liquid, or is he not liquid?
Well, it depends on the situation, the particular fund that we're going into. We can create liquidity for individual investors inside a fund if there is a cause for liquidity. We can't create a market and offer those shares out. That would be a violation with the SEC. But what we usually do is allow other investors inside the fund to acquire that individual shares to create liquidity for that individual. If no one steps up for that person to create a liquidity event, then as fund managers will acquire the shares and create liquidity for the individual.
So how does this happen when you're dealing with, well, someone in their 70s or 80s and someone dies? How do you create liquidity in their estate?
Well, typically someone at that age group may not be the perfect investment. We've had most of our funds run 5 to 7 years. So in a case like that, when I have an individual in their late 70s, 80s, we see them create a trust. So they'll put their grandchildren or another family member in the deal that way.
Okay, so they're protecting themselves not by investing it directly, but indirectly.
Right, because they know that it's money they're building generational wealth with for their families, and that's typically how I would go about that for somebody in that stage of life.
Okay, so what kind of percentages, what kind of investment do you look for, or what quantity of investment when someone has X number of dollars, are you looking to diversify into real estate?
Yeah, great question. I think, one of the rule of thumbs is looking at somebody's net worth, and then we can determine, the allocation depending on that. And we always refer to the Tiger 21 study, which is a group of successful individuals with $10 million net worth or above who do a lot of tracking on this. And so we see individuals with, let's say $1 million to $3 million in net worth, or below, typically 20% allocation to private real estate. As people's net worth go up, we see their allocation of private commercial real estate go up along with the net worth. So I typically like to put the brakes on at about 40%. That's a very high number if somebody's really wants to move away from the Wall Street side. But I also still caution our clients that they still need exposure to Wall Street. They still need exposure to other different investment vehicles. So I would say, to answer your question, 20 to 40% allocated to real estate.
Okay. And with that, how do you determine which investments in real estate? A lot of the money, I think, are probably that you deal with are IRAs or retirement accounts. How do you deal with real estate in those accounts?
Well, it goes back to depends what the client's end goals are. For example, a lot of clients in today's world want income. They want instantly to receive a cash flow income dividend check from their investment. So in that case, we would probably put them into some of our triple net retail deals that will guarantee that income stream. If an investor wants a higher return, obviously the risk profile will go up. So in that case, we may put them into a new development project. So the problem there is you're not going to have any cash flow for maybe 3 to 5 years while we're going through the entitlement side, doing construction, doing the lease up of the property. So that's something you've got to take in consideration. So it once again boils back to the individual, their suitability, and what their end goals are.
Okay, well, let's take a break. When we come back, I'll continue the conversation with Mike Brown, the CEO and founder of Red Fox Capital and Red Fox Wealth. And we have a couple commercials. I'm Allan Hirsch of Allan Hirsch Advisors, and this is AHA Business Podcast.
Hi, Rick Dempsey here. As a former Oriole and Series MVP, I know a lot about winning and championship teams. Today, I am happy to tell you about my award-winning web design and internet marketing team, Adventure Web Interactive. For over 2 decades, many of Maryland's most successful firms have chosen Adventure Web as their strategic partner for web design and online marketing. I can tell you from using them personally, their search engine optimization and social media programs have saved their clients tens of thousands over the traditional pay-per-click digital agency. Visit adventurewebinteractive.com and listen to what clients such as Hercules Fence, TriStar Electric, ABC Rental, Rhine Landscaping, Markdown's Office Furniture, and many more highly successful firms have to say. And don't forget to tell them Rick Dempsey sent you.
Strengthen, protect, and preserve your retirement nest egg. Scott Garceau here for the Stephen J. Sless Group, Baltimore's reverse mortgage specialist. Reverse mortgages have evolved to become a viable retirement tool. Enjoy retirement without monthly mortgage payments, improve cash flow, pay off debt, and stretch retirement savings. Stephen and his team can offer strategies to make housing wealth work for you. If you're 62 or older, learn if a reverse mortgage could help. Visit reversebaltimore.com.
An equal housing opportunity lender. This is not a commitment to lend. Stephen J. Sless, NMLS 298581. BRMI, NMLS 3094.
With me is Mike Brown, CEO of Red Fox Capital and Red Fox Wealth. Welcome back, Mike.
Thanks, Allan.
So when we talk about real estate and we talk about investments, you know, we're trying to balance out portfolios. So what do you do to balance that with the investments in the stock market? And I guess it depends on risk management.
Absolutely, it does. I would say the first thing is, you know, we want to create a hedge against the traditional Wall Street exposure. So in doing so, we would step back and say, you know, let's dip our toes in. Let's look at, you know, 10 to 20% exposure. And we've run some charts. And I think, you know, in the book, I've run out some charts with the S&P 500 and the traditional returns from the S&P. And then we take two approaches. We start showing an infusion of private commercial real estate with 10%, with 20%, with 30%, and then show the returns adding in the commercial real estate with their traditional S&P 500 exposed Wall Street. And when you see the returns, we're able to drive 3 to 5% higher returns adding in the commercial real estate. And in doing so, we're also reducing the overall risk. So when the numbers, when a client sees those numbers, which are all historical, you know, we can't predict the future, but it's a glaring facts shoots out about how awesome it is to infuse that real estate in their portfolios.
So describe your management strategy and how investors can today, with COVID being, believe it or not, more than 6 months old.
Right.
I'm getting actually bored sitting here.
Right.
Sitting here at home doing the podcast and doing my work. But what are some of the things that you're doing in this political uncertainty?
Well, it's been interesting. I mean, we actually had a lot of properties under contract early on in COVID, and we had to pull out because a lot of the lenders were afraid. They're like, how do we put an appraisal, how do we put a value on this? Because we, you know, in early March, it sounded like the whole world was going to come to an end. So we had to step back. We're now getting back into the market. The residential side is obviously doing very strong right now. Typically commercial lags about 18 months behind residential valuations. But we've seen the commercial real estate market very strong right now, other than general office space. So, you know, we've got to make those strategic decisions and look forward 5 to 10 years and, you know, how we can, you know, maneuver our assets to our clients' goals. Whether that be, you know, maybe having to leave the Washington, D.C. geographical area where we see better opportunities. We do that. We do have a circle. We like to get to all of our assets within a 3-hour car drive. So we have, you know, hands-on management availability. But, you know, that's how it is. I think, you know, with the political uncertainty, there are some things out there. I think we're going to deal with the higher tax environment. I think with the $27 trillion national debt, I don't know if we have much choice. That taxes are probably going to go up. We at least know that the Trump tax cuts will sunset in a couple of years.
Well, they sunset when at the end of his second term.
Yeah, maybe. Yeah,
because
if he gets reelected, we don't know.
In 2025, which is the end of his second term, if he gets reelected, and if he doesn't, there'll be tax increases on the wealthy. I don't think there'll be many tax increases on the up to $400,000. That's what Biden is saying, but you don't know what Congress will come out with, depending upon the results of the election in 40 days.
Absolutely. I'll tell you another interesting technique that we're using, speaking of COVID, is the Stimulus Act. And we now have until end of the year that you're able to take out up to $100,000 on your 401k and move it into another investment vehicle. So what we're advising our clients to do is, assuming we all believe taxes are probably going to go up, take your $100,000 out, pay your taxes now in this low tax environment, move that $100,000 into maybe a real estate vehicle or any other after-tax bucket. And we've run the numbers and show that it's really a smart move with your dollars between now and retirement age.
So if someone had both the retirement account, which is not taxable until death.
Correct.
It's actually double tax plus income and estate tax if it's over $12 million now in the federal estate tax. States can be different. And you had a Roth IRA, you could then put it into a Roth.
Correct. Absolutely. And inside that Roth, you can obviously have your options of where you want that money placed. So I've been reaching out to clients here the past 2 months, working on that. It's been a big hit. People realize that, and we've always been taught, Allan, that you're always going to be in a lower tax bracket in retirement age.
And that's not true.
We don't think that might be true now, right?
It might not be true now. I mean, you build this wealth in the wealthy are building a lot of wealth, and it might be higher tax brackets when they retire. Right.
And another strategy, Allan, we're using with clients is, if you've heard of the index universal life policies. I've
heard of them. I don't have one, but they're interesting.
They've been described as commonly as a private banking, infinity banking, the president's fund. There's all kinds of names for this particular policy. But what it simply is a vehicle where you put your money in, you fund your life insurance policy. You're getting a dividend check from a mutual life insurance company. So you're adding your wealth there. And then the money is hooked to an index. We use Bloomberg index, the Zebra index, which does trace the Wall Street upside. So you have the upside of Wall Street, but you don't have the downside because we're not actually in the marketplace. And then that builds up over time, and you're able to take out that money in retirement tax-free. And it can also be used for real estate investing. You can take cash out of the policy and invest in other products. You can use it for long-term care benefits without any of the red tape. There's a lot of hard hurdles you have to get over to use your long-term care insurance. And there's lots of benefits for that. So I ran one of those scenarios for a gentleman 2 days ago, and with his $100,000 infusion using the COVID stimulus loophole, he's going to generate $45,000 a year for life tax-free. It's pretty strong.
With what investment?
With $100,000 into the insurance policy.
Okay, so he's got a $45,000 a year income?
Yes, when now he's younger, so he's in his late 40s, so he has time to build that up. But he is going to, when he turns right at 63 years old, he's going to be able to take out a tax-free year. It's basically a private pension. Has a guaranteed $45,000 for the rest of his life every year.
So the principal stays in the company.
Well,
what happens to the principal, the 100,000 and the growth, if he were to die at 65?
That will be passed on to his heirs.
Okay, so this is a insurance policy as well as a universal
It is an insurance policy.
policy.
Yes.
It's not a annuity.
No, it's not. No, it's not. It works somewhat like an annuity because it is safe. It's secured. You're not going to lose your principal in that case. And you play in the upside. So you have that opportunity to play in the upside. But a lot of our clients use those vehicles to then take cash out as a loan and then place those in real estate opportunities. Like you mentioned before, a lot of people use their self-directed IRAs, 401ks to take money out and invest in real estate.
So what is the tax implications? Because there are some, and I don't know
Sure.
what the implications are for someone that's investing in a fund versus directly into real estate.
Well, in the case we just talked about, so if you took out cash in the 401k right now, you have 3 years to pay that tax liability, so you can spread it out. In the case of taxes in a fund, we have a carried interest set up, so which is also has been debated on the Capitol Hill to get rid of that. It's kind of like the hedge fund tax implications. So we're able to go to capital gains tax instead of ordinary.
So it is a taxable investment.
It is a taxable investment.
Okay. As ordinary income, or is some of it capital gains?
Capital gains. Yeah, because we hold our properties long enough that it'll be treated as capital gains.
So that when you cash out, that money is capital gains. When you get your dividends each quarter, that's ordinary income.
Right.
Okay.
And one of the things when we were doing a lot of new construction and selling office condos, we sold a lot of medical condos to doctors. Doctors love to own their own office space. And the problem with it was always a taxation issue because it's under a year. If we deliver that property, we build it, we deliver it back to the developer and back to our investors, it's considered ordinary income because we're not holding it for a year. So there are some serious tax implications there for that need to be aware of.
Okay. So, you want to work with people. So you actually have an offer to make?
Absolutely. I think for all your listeners, we would love to, answer any questions, especially what you pointed to today. It's like, how do I know my allocation? How do I know, am I balanced? Where do I stand? Anybody that would like, I'll do an analysis for them. Complimentary to your listeners, where we can look at your financial plan. As I discussed earlier, the buckets, we would put all your allocations and look at the different buckets and look at your goals, retirement goals, income goals, and help you point you in the right direction and tell you how much you should be allocated in each bucket.
Yeah. So, and we'll get to you where you can call and reach out to you in a minute or two. But what kind of returns can you expect from the real estate versus the stock market?
Absolutely. So, and some of the income producing properties that we spoke about earlier, the way the funds are set up, we have a preferred return, which usually runs, between 8 and 9%. So that is a you can't say the word guarantee, but that's our fixed return. So the investors are going to get that preferred return first. At the end, you have what we call a windfall. So when we sell the portfolio, the large profit then comes back to the individual investors. I had an individual describe it to me like having a CD rate, that preferred return, that's coming. And then it's attached to a lottery ticket at the end, because that's when we sell the property. And we are compensated on the performance of the funds. So all the money comes out to our investors, and then we participate on the bonus on the back end. So we are heavily incentivized to drive a larger return. So overall, Allan, I would say on that situation, those returns would be about 11 to about 13% internal rate of return. The higher the risk profile, obviously those returns go up.
Right. So
if we're doing a development project where there's more risk, or a value add that we're repositioning a property, you can see those returns go up to near 20%. anything above 20%, I would raise a red flag to all investors that that's probably too good to be true. And people are wiggling the numbers around at that point.
Yeah. So, Mike, thank you very much for being a guest on the podcast. How can the listeners take advantage of your offer and reach you for balancing out, getting advice on their portfolio?
Sure. Well, you can check out our website. It's redfoxcapital.co. And you can use my personal email address too that I've got dedicated for all your listeners, which is easy. It's Mike Brown 1757 at Gmail. And I'll respond to you as quickly as possible, and willing to offer any advice or any information you may want. I'd be happy to.
Well, thank you very much for being on the podcast. I think it's very informative because so many investment advisors, as you say, are forbidden to invest in real estate. So
Absolutely.
Thank you very much for being here. My guest next week will be David Sherry, General Business Strategist. I'm Allan Hirsch of Allan Hirsch Advisors, your host. To reach me, call 443-977-4500. Visit my website, www.allanhirschadvisors.com. You can follow podcasts of past shows wherever you get your podcasts. So I'm Allan Hirsch, and this has been AHA Business Podcasts.